chart. And I'm going to pause this while I write all this stuff down. So, okay, the stock charts are graphical forms of the data, or pictorial forms of the data. And the reason they do these is because the data charts, rather than looking at a list of numbers and trying to figure things out and seeing trend, if you look at a data chart, you have a picture of the trend. So it's quick, you can look at it quickly and kind of see what's happening. So that's what those are for. This one right here is called a stock bar chart. It's a really common form. Okay, there's two graphs on here. The top shows the high, the low, open and close. And the bottom shows the volume. Okay, so what you have is, when you look at this, I mean, it's just a bunch of sticks, right? It's kind of confusing. This is what the sticks represent. The top of the stick is the high, the bottom of the stick is the low, on the left is the open, and on the right is the close. So if this doesn't have the scale, but there would be a scale along the side here that would be like, you know, maybe $20, $30, $40, you know, etc. So where that appears on that scale, in this case, the low might be like 35, it opened at 40, it closed at 60, and the high was 70 or something. Does that make sense? And then the volume, usually the scale is in the hundreds or millions or thousands. And so this might be 10, 20, 30, 40, 50. And if this was hundreds, that would be 50, 100s, so that would be 5,000. And that's what this part tells you, just how many sales or how many shares traded. So like this, these are usually daily, so this would be Monday, Tuesday, Wednesday, Thursday, Friday, following Monday, Tuesday, Wednesday, Thursday, Friday, like that. And by looking at this, you can say, okay, well, this stock, it went down, it's starting to go back up, but look, it's going back down again. The volume of the trades are decreasing. Maybe I don't want to buy that, or maybe I do, because maybe you're going to speculate that it'll go back up, and you buy it here at a really cheap price, and then you're going to make all this money later. So, you know, usually if we're going by days, this is like 2.5 weeks. That's not enough time to look to see the real trend, but that's what stock analysts are looking at. This is an actual chart for Bank of America. I want to say it's from like 2012, maybe 2011. I don't remember. But this is an actual chart. Now, you've got some red and you've got some green happening here. That doesn't always show up, but in this particular instance, if you can see how the opening is on the left and the close is on the right, it's red because it closed less than it opened. And it's green if it closed higher than it opened. So we've got June 19th. It's going down, 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 comes up, goes down, comes up, it squiggles around, you know, it does all this sort of weird stuff. Volume-wise is in the millions. So on, let's say, September 16th, 17th, September 17th, that looks like 175 million shares were sold that day, or traded, bought and sold. So that's how you would read this actual chart. On the same day, September 17th, the open was probably around 28.50. The close was like 27.10 or so. The high is like 29.50 and the low was 26.50. These are approximations, of course. Like, I don't have the exact change amounts, but you can see that it opened okay, but it closed kind of bad. You see that? Okay, so we're going to use this chart to answer some questions on the next page. I'm going to be skipping back and forth. And which day had the greatest high price? Okay, so we're looking at the tops of the sticks. So which? Yeah, September 8th has the greatest high price. And we want to know what this price is. Well, it's topping out, so I'm going to say 36. Okay, so good. Okay, the least low price, we're looking for the one that the stick is at the very lowest, which is going to be here. So that's July 15th, actually. Oops, wrong one. Yeah, probably $18. Is that making sense for everyone? Okay. Oops, wrong way. Okay, now let's look at the closing price. Now remember, the closing price is the one that's happening on the right. So you have to compare, like, we're looking for the highest closing price? Yeah, highest closing price. So we have to look at all these ones on the right and see which one is the highest. That's the same as the highest day. Yeah, so 34.50 on September 8th. Do you guys see all that? Is that okay? So it's, oh, okay, yeah, if we come down this line, that one says September 8th. On your paper, it'll be easier for you to see. So we've got 9/8, and it was 34.50-ish. On these, if you were to write 34.60 or 34.70 or 34.40 or something, I'd be like, nope, you're wrong. I couldn't possibly, I don't know exactly how much it was. It's around there. So if you're in this general area, you'd only be wrong if you said like 35 something or 33 something. If you're in between 34 and 35, you're good. Okay, lowest close. We're coming back down here. 15th again. And we're just above 18. Do you see that? So I'm going to say maybe 18.25. I have no idea. Now, how many shares of stock were sold from has an O in it? Okay, from September 8th until the end of the chart. So we want to look at that. So September 8th is right here. So I have maybe 160 million plus like 110 million. So I'm going to write those down. And then I've got like just under 100 million, so maybe like 90 million. And then 100 probably exactly-ish. And then this one might be, what do you think? 80? Okay, so we'll do 100 and an 80. And then I've got, well, we're going up in 50s. So that would be 300 probably, or close to. And then I've got, both of these are about the same. What do you think that is? 175-ish? Sure. Okay, now I have to add all those together. I'm going to do it the lazy way. So I'm going to do 160 plus 110 plus 90, 100, 80, 300, 350. Okay, now I'm saying 1,190 million. That's about how many shares were sold between September 8th until the end of the chart. Now, if you get anywhere in kind of this range, because we're not talking exact numbers, right? My 80 might have been your 70. But that's about how many were sold. So that just gives us a lot of information with the picture, rather than having to look at like lists and lists and lists of numbers like we were doing yesterday. All right. Bank of America is a major corporation. So we're, okay, BAC, this is on the New York Stock Exchange. So we're closing at New York, but New York's not the only stock exchange. So it closes in New York at this rate, but then when the New York Stock Exchange opens again, it's changed overnight because like maybe the NASDAQ was still open, or Japan, or London, or, you know, there's stock markets all over the world that are going to be trading Bank of America stock. Yeah. You sure? Bar chart. Okay, so we're gonna create a one-day stock bar chart using this information. So the first thing we want to do is we want to use a color that'll show up. And because I'm crazy, I got my scale. It's happening here. And we're going to split it into two sections, right? Because I have the bar chart part and the stick part. Okay. And now I need some sort of scale. Well, my dollar amounts are going between 39 and 41. So I'm just going to do 39, 40. That's a terrible 40. 41. And then my volume is like 44.5 million. So I might do like 43, 44, 45. And then you have to somewhere indicate that it's millions. Because if you don't indicate it's millions, it could be hundreds, it could be thousands. So you need to indicate it's millions. Okay, so my open and close, that's the length of the bar. So I'm going from 39.79, which is maybe, what do you guys think about there? To 40.10, which is probably about there, we'll just guess. And I'm making a straight up and down line. My high is, oh, wait a minute. I looked at the wrong numbers. Sorry, open and close instead of high and low. Okay, 40.65 was my high. So that's up here. 39.39 was my low. Catch me when I do stuff like that. You get extra credit.
Does it count if I tell you that your dad's a little too close to 41? Does I get extra credit?
No, that's just being picky. Is that good? Okay, so we're wherever. It's approximate. How's that better? Okay. Now, open is 40.10, so that's about like that. Close is 39.79, so that's maybe, what do you think there? Good? Okay, and then my 44.5 million, 44.5 is right here. Okay, there you go. Now on the bar charts like this, typically speaking, the two colors you see are black, white, red, and green. Red and green, obviously red is bad, green is good, like stop and go. Black and white, if it's good, it's usually white. And if it's not good, it's usually black, but that's not like a rule. So you have to sort of look at it to decide. Could be, and they could use any colors. If somebody wanted to, they could make a stock chart using like pink and lavender chart. Now, a candlestick chart is called a candlestick because, hey, look at that. If you take off the bottom wick, it looks like a candle. Okay, so you still have the high and low are on the straight line, except instead of having just a stick going out, you have a box. And the box encompasses the open and the close. Now, if the open is higher than the close, you have one color. And if the open is lower than the close, you have, so if it did well, so here we have stock went up, it's white. If the stock went down, it's black. If they're using red and green, this would be red, this would be green. And like I said, it could be any two colors selected. Now on the Bank of America chart, the bar chart, they don't have to tell you what colors they're using because it's, if you can look at where the lines are and you can figure out the colors, but on a candlestick chart, there has to be some sort of a key that tells you what colors mean what. Otherwise, you can't tell, like, because it's not, there's, you know, the open and the close, they look the same. It's a rectangle. This is an actual from the same time period as the one I did, the Bank of America, which I think, like I said, it was either 2011 or 2012. This was Microsoft. And this is on the left. This is the dollar amount. And on the right, this is the sales in the millions. Okay? Yeah, so this is the millions, and this is the money. Okay? Now, I would not necessarily have known that just looking at this, except that I know that Microsoft does not sell at this highest at like 26 bucks. Right? Microsoft stock is much more expensive than that. So that's, but usually it'll be, if they do a scale like this where they overlap on a candlestick chart, money will be on the left generally, and millions will be on the right. Okay, so here's our candlestick chart. These white ones, these are the days that it opened and then closed higher. And the black ones are the days that it opened and then closed lower. Okay, so if we are going to use this, we go back here and say the difference between the market action on the 10th and the 11th. So here's the 10th, here's the 11th. If I look at that, on the 10th, what do we have? Yeah, we have a decrease. So it opened higher than the close. And on the 11th, that's here, it closed higher than it opened. So it kind of gained it back. Okay. Now, the other thing that we can tell looking at this between the 10th and the 11th is that the volume of sales decreased between the 10th and the 11th. So, or they're not sales, sorry. I need to stop calling them sales. They're trades, because they're both buying and selling. This price on the lowest price for the month. So we're going to go back. Okay, and the highest price, we're looking at the bars. I'm going to say this one looks to be a little higher than that one. What do you guys think? Okay, and so that one's somewhere close to $270. So what do you think? $265? Yeah. Okay, so we're going to say that $265 was the high. And then the low is way over here below this line. And this line was 90, so we're going to say the low would be, what do you think? 87. 87, okay. Yeah, that's right. So it would be a $178 difference. I'm going to write these down before I start talking about them actually. Okay, so the smoothing techniques are statistical tools that allow you to, on that Bank of America one, how it was kind of doing this sort of thing. What the smoothing techniques do is they take that wobbly line that would be like this, and they make it more like that. And you get rid of all the little ups and downs, and it makes it a smoother line so you can see the big picture. You can see the pattern or the trend better.
Basically averages everything out so that it becomes smooth.
Mm-hmm. Yeah, and it does that with what's called a simple moving average. Now, they call it a simple moving average. They're lying to you. Okay? Their smoothing technique, they're calculated is one of the most common smoothing techniques is the simple moving average. And what's done is blocks of time. So like say you have a month that you're looking at, there may be 3-day or 4-day or 5-day blocks of time where the averages keep getting taken for these 3 and 4 or whatever days of time, and it moves. That's why they're moving averages, as they move. So you start on Monday, then you start on Tuesday, then you start on Wednesday as you go through. And those are lagging indicators. And the reason they're lagging indicators is because you are using past data. So if you're using a month's worth of data, that's from the last month. But it helps you to follow trends. It's not up-to-date information, but you can still see the patterns that way. It would be impossible to follow the stock market like on a moment-to-moment basis and see any kind of pattern or trend. It's too much information. It's all over the place, because during the course of a day, the price of a stock can fluctuate hundreds of times, thousands of times, millions of times. Every trade could be a change in price. It would be impossible to, really see what's happening with that. So that's why we use these lagging indicators and smoothing techniques to see pictures. Here's how this works. It's a 5-day SMA. So we're going to take the average of 5 days at a time. And we're going to start with days 1 through 5. So that's our first average. Our second average, you don't have to do this part if you don't want to, is days 2 through 6. I don't need any more colors, so purple. So then we go 3 through 7. Do you guys see what's happening? It's 5-day blocks, but it keeps moving. So the way that works is we have 1 through 5, 2 through 6, 3 through 7, 4 through 8, 5 through 9, and 6 through 10. Yeah.
So you just do the past 5 days of your information just to get a better.
You do 5 days, 5 days, 5 days, 5 days. And so we're going through this 10 days. So to do the 5-day simple moving averages for 10 days, we have to do 1, 2, 3, 4, 5, 6 averages. That's just for 10 days. If we had 30 days, we'd have to keep going up until we hit the 30th day. I'm going to show you 2 ways to do these. The first way is the most straightforward way. And what we do is we add up the closing price of these first 5 days. So here's the first step. We're going to add up those. Okay, that's 5 days, right?
Look how simple it is.
So we're going to divide by 5. And when I add all that up and I divide it by 5, I get 35.22. Okay. Now for the next one, I'm starting at day 2. And I'm going for 5 days. So here I started at day 1. And here I'm going to start at day 2. So starting at day 2, oops, 0.65. Add all those up, divide by 5, and you get 35.31. For the next one, let's do green. We start at day 3. So you're always dividing by 5 because it's a 5-day average, and you get 35.32. Day 4. Divide by 5, and you get 3555. Day 5, we're almost done. Last day. Okay, these are my moving averages. Now here I go down, I go down, I go up, I go down, I go up, I go down, I go up. Do you see how it's like going up and down and all over the place? But look, up, 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 up. It's a consistent increase. So the pattern on this, if I look at this, it's going to look very different than this. We're actually going to graph those so that you can see what we're talking about. So I'm going to just, well, hold on. When you comparatively graph these, the daily starts on the first day. Okay, so if I start this, I'm just above 35, and then I'm even closer to 35 over here, and then I go down to 34 something, 34. Oh, don't move. Sorry, hold on. Okay. Closer to 35 than what it was, 34.65, so just above 34.50. And then way up to like 36 something. And then back down to under 35.50. Or sorry, right here. Then back up. Then back down. Then up. Where was that? 30, halfway between 35.50 and 36. So somewhere here. And then 37 something. And then 36 something. Okay, but when I connect the dots on this, you say, okay, that's all over the place, right? If I do the SMA, the simple moving average, on day 5, we start on day 5. And the reason we start on day 5 is because we're starting on the last day of our average. So the average was days 1 through 5, so we start on day 5. Okay, so we start on day 5, and day 5 is 35.22. So that's 25, so there's 35.22. Then I have 35.31, bless you. 35.32. 35.32 should have been here, sorry. 35.55. So that's up here. 35.74. 74. Oh, sorry. I'm getting way above myself. And then 35.89. This is much easier to see the picture of what's happening. Do you guys agree? Okay. I'm going to stop there